Okay, so we're talking now about the constant growth dividend model. So what we're assuming here, I guess this is a model that you would use for ordinary shares. You'd say, look, we expect this company to be paying a dividend, but we expect the company, because it's profitable, it's retaining some of those profits, some of those assets to reinvest in the business, it's growing. And so we expect the company to be growing, its profits to be growing, its assets, of course, to be growing, and therefore, hopefully, if the directors are sensible with higher profits, they're paying out a higher dividend to keep the investors happy. Okay, go back to the perpetuity model where you've got a growth factor. So in that case, and we've got it here, the present value is the first cash flow, right? Remember, the cash flows are all different, they're growing. So we work with the first cash flow. The first cash flow divided by the difference between the rate of return or the yield that you want, and the growth. Okay. Actually, I'm bad at writing, I'll just point to that. So that's the formula that we use. Okay, now, as I've already said, assuming constant growth is a little bit radical, right? I mean, the idea that a firm can grow at a certain rate forever into the future, with changes of management, changes of strategy, changes of economic conditions, it's probably quite unrealistic. So as I said earlier, what we often tend to do is we tend to assume that growth will persist for a certain period of time, a few years where we think growth's going to be really great, and then it's going to settle back into a lower growth rate. So that's essentially what a two-stage model is. It says, look, what's the dividend we expect this year? How quickly do we expect it to grow for some period of time? And then after that, it's going to grow for a shorter period of time. Okay, so again, we're making some assumptions about reality here. All right, well, let's say that an investor has been offered some shares in CAC Limited, which is a new business venture. They don't expect to be able to pay a dividend for the first year of operation, but they expect to pay their first dividend of 50 cents at the end of year 4, and then they expect the dividends to grow at 12% a year. What price should an investor be prepared to pay if they want a 40% return? Now, this is sort of a cool version of the two-phase model, right? Two-stage model. Because what we're really doing is we're saying there's a first stage where there's no growth, right? They're not paying any dividends. They're just growing like crazy, reinvesting. And then 4 years down the track, they expect to pay their first dividend. And by then, the business will be running pretty well, and they're expecting to pay a reasonable dividend out, and that's going to grow by 12% a year. Okay, so we want a 40% return. Okay, have a bash at that. Okay, did you have a go at it, or did you just turn the page? Well, let's have a look at it. This is a two-stage growth model, but it's actually pretty simple, except there's one little trick to it, right? So the situation we had was that we're expecting not to pay any dividends out. What did we say? We're not expecting to pay any dividends out until the end of year 4. Okay, so year 1, 2, and 3, no dividends. So no cash flows in periods 1, 2, and 3. Year 4, there's going to be a cash flow of 50 cents, and then it's going to grow by 12% thereafter. Okay, so it's going to be somewhere 56-ish. Oh, no, a little bit over 55 in year 5. Okay, so firstly, the way we best approach this is we can basically say, hey, what's the value of the firm? Sorry, I should have done that. We can say, what's the value of the firm at the beginning of year 4? Okay, so the first cash flow is here at the end of year 4. The next one's at the end of year 5. Okay, etc., etc., etc. So this is a normal annuity with growth. Okay, if we're looking at this from period 3, the first payment is from the end of period 3. The first payment is at the end of period 4. In other words, 1 period away. The next one's 2 periods away, and there's a constant growth rate. So we can work out what the price would be at period 3 just by working out the present value of an annuity. Okay, so the dividend we expect at period 4 is 50 cents. We want a rate of return of 40 cents, but we want growth, or we're expecting growth of 12%. Okay, so we come up with $1.78, almost $1.79. Now, bear in mind that is the price of those cash flows if that price is calculated at period 3. But we're not actually calculating this at period 3, or end of period 3, beginning of period 4. We're actually calculating it at date 0, which is the beginning of period 1. So this is a cash flow 3 periods in the future. We've calculated cash flow as at date 3. We need to bring it back because we're wanting to price the share today. We're going to bring it back to today dollars. So if we've got the price as at date 3, we need to bring it back to date 0. Our discount rate is 40%. So there's 1 plus 40%. Multiply that by 1.4 to the power of minus 3. Or alternatively, what we're really doing is taking 1.7857 and dividing it by 1.4 cubed. That would tell us that a reasonable rate of return to pay, a reasonable price to pay would be 65 cents. Okay, so let me just show you one of these little tables just to prove that this stuff makes sense. I whipped this up in Excel. So here's the 65 cents we had as a result from the calculation. Mind you, that's not exactly 65 cents. There's a few decimal places there. So how are we expecting the pattern of things to look? Remember, this is the opening balance period is 1. So that's at date 0, which is the beginning of year 1. So we've got a return, which is the 40% that we want. That gets added on, the price goes up. The same happens next year. 40% return on 91 is 36 cents, gets added on. So by the time we get to the beginning of period 4, so date 3, we have $1.79. It's actually $1.7857. Is that what we had? Yeah, 1.7857. Okay. And then the first dividend kicks in. So we add the return, in other words, the value of the share grows, but then some of it gets paid out, and what's left should be the closing price, $2. Same next period, the opening balance plus the return, 40% of that price, less the amount that gets paid out. Now, what is this 56? It's the original 50 cents growing by 12%. Okay, so we're seeing the dividend grows, the payment grows, but what's left gets added to the price. Now, since there's a constant relationship between the return and the price, if the dividend is growing, the dividend is growing by 12%, then so must the price of the share. So let's just have a look. $2.24 divided by $2, it's growing by 12%. Okay, so the share price is growing by 12% after the dividend kicks in. And is the dividend growing? Well, we've structured it so it is. Yep, the dividend is growing by 12%. So I've structured it right. So essentially what's happening here is, since you don't have any cash flows in the first few periods, you've basically got that return being added to the price, the required rate of return. Now, obviously, if you require a higher rate of return, you're going to give them a lower price up front. Okay? So that's just showing you how those numbers work out. Okay, so that was a somewhat complex one. Now let's do something a little bit simpler. Keen Company's offering a preference share issue. Okay, so remember, constant preference dividend, $8 annually. The required rate of return on the preference share issue is 10%. If Keen offered to you the preference share at a price of $75, would you buy it? Look, the answer's down the bottom there, but just think about this logically. If $8 is the dividend that's being paid, how much would you pay for $8 to be 10% of it? You'd pay $80, right? If you paid $80 for this preference share, getting that $8 dividend year in, year out would give you a 10% return. Now, if you pay less, the return's going to be bigger compared to what you put in. So if this guy is offering you the share at a price of $75, would you take it? Yes, you would, right? The share is underpriced, because if you're happy with 10% rate of return with an $8 dividend, you would be willing to pay $80 for that preference share. This guy's giving it to you for $75. So, oh yeah, definitely, you would certainly go for that. Okay. Now, a few multiple choice questions just to give us a little bit of stuff to think about. Okay, remember what I said up front about different yields for different periods. And remember also one of the key differences between short-term bonds and long-term bonds is there's a lot more cash flow in long-term bonds, right? Long-term bonds were heaps of cash flows into the future. Short-term bonds have only got a few. So if the market rate of interest, the rate of return that people want, changes, what's likely to vary more proportionately, okay, percentage-wise? The short-term bonds, the long-term bonds, they vary at the same rate, they're not affected. Look, it's clearly not D, because if the rate of return changes, you're going to differ, you're going to want to offer a different price, right, to make sure you get a reasonable rate of return. Do they vary at the same rate? There's no reason they would. In fact, it's not, they might, but the mathematics is complicated. There's a lot of terms for the long one, few terms for the short one. Why am I always working backwards through these things? Let's have a look at A. Short-term bonds vary more than the value of long-term bonds. And let's compare that against alternative B. Long-term bonds vary more than the value of short-term bonds. The answer is B. We can whip through and see that it's B. Why is it B? Think about what you're doing when you're working out the value of long-term bonds. You're discounting a whole bunch of cash flows. There's a whole bunch of terms with the discount rate in them. Okay, it's a polynomial. Okay, they're divisions, but there's still a lot of terms that are affected. So every time that you change the discount rate, the upfront cash flows might not change a lot. From 9% to 10%, probably not a lot. But the further out you go, the higher the exponent on those terms. 10 years out, 10 periods out, any change in the interest rate is being raised to the power of 10. So that might have a substantial amount once it's accumulated from 10 periods out. Generally, long-term bond prices are going to vary a lot more to small changes in interest rates. You might be thinking, hang on, but if we're talking about short-term interest rates, why would that affect long-term bonds? The question doesn't say short-term interest rates. Remember that short-term interest rates actually have two impacts. One impact is, yes, pricing short-term bonds. The other impact, when people see short-term interest rates, they use that as a sort of default expectation for the future. So they assume that if short-term rates have gone down, long-term rates might not necessarily be the same, but maybe they've gone down too, if they're expecting the cost of capital to have decreased semi-permanently or permanently. Okay, next one. If an existing bond issue was originally issued at par, in other words, people paid face value for it, and interest rates increase, the existing bonds will, what will happen? Well, remember that bonds are issued, but they still trade in the market. And, for liquidity reasons, hey, I might retire and I need to take the cash out. I sell some of my bonds. Somebody else buys them. What price will I get for them? Well, if people want a higher rate of return, remember, they can't change the contractual cash flows that the bond offers. If they want a higher rate of return, the only thing they can do is offer a lower amount. So offer a lower price. So what will the answer be? Well, they'll sell below par. The price will drop to below face value. Okay, now let's think about valuing a share. Previously when we had a look at valuing a share, we said, let's assume that the dividends continue into perpetuity. That might not be the reason why you're buying the share. You might actually be planning to sell it at some stage in future. To be honest, it shouldn't make a big difference whether you're intending to sell it or keep it, because the person down the track who's going to buy it from you will be valuing it the same way you'll be valuing its value at that point in time. So when you value a share with non-constant dividend streams, so the dividends move, what do you need to do? If you're intending to sell it, do you need to estimate the price of the stock in the future period that you intend to sell it? Yes, that's something you do need to do. If you like, that's an annuity of all remaining values after that date. And that's what people would pay for that share. Estimate the expected dividend in each period that you intend to hold the stock. Yes, of course. I said that up front. mean, we're making assumptions about constant dividends or constant growth or two-stage growth, but in reality, they're only really rough approximations. I mean, if you can come up with better estimates because you happen to know what the company's dividend policy is, then you use that. You're trying to basically say, what will the cash flows be in future periods? Because those are the cash flows you're interested in, and that's what you need to discount. Do you need to estimate the discount rate appropriate for the risk exposure? Yes, you need a rate of return that reflects your attitude to risk and your attitude to the time value of money. So they're all true. So I can let you pause, but it's clear that the answer is actually D. Okay, let's have a look at the next one. What's the value of an ordinary share which paid a dividend this year of $2 and has an expected growth of 8% a year in perpetuity? The required rate of return is 16%. Okay, have a think about that. Okay, so this one is actually a little bit of a trick because they've told us that they've paid a dividend this year of $2 and they've got an expected growth of 8% a year in perpetuity. Okay, so basically that means that the first dividend we're expecting to get a year down the track is not $2. It's $2 plus 8%. Okay, so the calculation will look something like this. The first dividend is going to be $2 grown by 8%. Okay, and we divide by the rate of return that we want minus the growth rate that we want. 16% less 8%. Okay, and once you knock that out, that gives you $27. Okay, so if you got $25, what you forgot to do is grow that $2 first before sticking it into the formula. Okay. Okay, if you see my head jiggling around a bit, it's because I paused to work this stuff out in Excel. So we've got a 20-year government bond trading in the market at a yield of 9% per annum, compounding semi-annually, and interest payments are paid half-yearly. The bond was issued 12 years ago today. What's the current market price of the bond if the coupon rate is 8%? 8% per annum, and the face value is $1 million. Okay, so we've got a 20-year government bond, and it was issued 12 years ago. So there are 8 years left to go. But all the payments and the compounding here is semi-annual. So the 8 years that remain are 16 half-year periods. Okay, so we've got 16 periods remaining. So over in Excel, which I've set up 16 periods, the coupon is 8% per annum, so that's 4% every 6 months. So that's a coupon payment of $40,000, and face value is $1 million. Okay, face value is $1 million. So we're going to discount this for those 16 periods, 8 years times 2 periods a year, at 9% per annum, but remember it's every 6 months, so it's 4.5% per every 6 month period. So here's what I got in Excel. These are the cash flows that we're expecting over 16 periods, but let's just go through the calculation here. So the number of payments per year, we know years to maturity, 8, so 16 periods. The market yield is 4.5% per period, per 6 month period. So remember once more, we're valuing a bond. We have two components. We've got the annuity for N periods, which in this case is 16, at a rate of 4.5%. Okay, that's what we're discounting at, 4.5%. And what is the annuity? The annuity is $40,000. That's the coupon that's being paid. So that's 4% of the face value. Here we have the face value at the end, again being discounted by the same discount rate, 4.5%, from 16 periods away. And that gives us 943,829.92. Down the bottom here, we've got some numbers for those of you who feel like doing this in financial calculators, with financial calculators, okay?